We will read Trading Price Action Trends written by A.L. Brooks. Technical analysis of price charts bar by bar for the serious trader. Contents: Price Action Part 1, Part 2 Trend Lines and Channels, Part 3 Trends, Part 4 Common Trend Patterns. There are 26 chapters in this book. Introduction. There is a reason why there is no other comprehensive book about price action written by a trader. It takes thousands of hours and the financial reward is a meager compared to that from trading. However, with my three girls now away in grade school, I have a void to fill, and this has been a very satisfying project. I originally planned on updating the first edition of Reading Price Charts bar by bar John Wiley and Sons 2009, but as I got into it, I decided instead to go into that great detail about how I view and trade the markets. I am metaphorically teaching you how to play the violin. Everything you need to know to make a living at it is in these books. But it is up to you to spend the countless hours learning your trade. After a year of answering thousands of questions from traders on my website at brookpriceaction.com, I think I have found ways to express my ideas much more clearly, and these books should be easier to read than that one. The earlier book focused on reading price action, and this series of book is instead centered on how to use price action to trade the markets. Since the book grew to more than 4 times as many words as the first book, John Wiley and Sons decided to divide it into 3 separate books. The first book covers price action basic and trends. The second book is on trading ranges, order management, and the mathematics of trading, and the final book is about trend reversals, day trading, daily chart options, and the best setup for all time frames. Many of the charts are also in reading price chart bar by bar, but most have been updated and the discuss about the chart has been largely rewritten. Only about 5% of the 1,20,000 words from that book are present in the 5,70,000 words in this new series, so reader will find little duplication. My goal in writing this series of 3 books are to describe my understanding of why the carefully selected trader trades offer great risk-reward ratio, and to present ways to profit from the setups. I am presenting material that I hope will be interesting to professional traders and students in business school, but I also hope that even traders starting out will find some useful ideas. Everyone looks at price charts, but usually just briefly and with a specific or limited goal. However, every chart has an incredible amount of information that can be used to make profitable trades, but much of it can used effectively only if traders spend time to carefully understand what each bar on the chart is telling them about what institutional money is doing. 90% or more of all trading in large market is done by institutions, which means that the market is simply a collection of institutions. Almost all are profitable over time, and the few that are not soon go out of business. Since Institutions are profitable and they are market. Every trade that you take has profitable trader a part of the collection of institutions taking the other side of your trade. No trade can take place without one institution willing to take one side and another willing to take the other. The small volume trades made by individuals can only take place if an institution is willing to take the same trade. If you want to buy at a certain price, the market will not get to that price unless or one or more institutions also want to buy at that price. You cannot sell at any price unless one or more institutions are willing to sell there, because the market can only go to a price where there are institutions willing to buy and other willing to sell. If the Imuru is at 1264 and you are long with a prospective sell stop at 1262, your stop cannot get hit unless there is an institution who is also willing to sell at 1262. This is true for virtually all trades. If you trade 200 E-mini contracts, then you are trading institutional volume and are effectively an institution, and you will sometime be able to move the market a tick or two. Most individual traders, however, have no ability to move the market no matter how stupidly they are willing to trade. The market will not run your stops. The market might test the price where your protective stop is, but it has nothing to do with your stop. It will only test that price if one or more institutions believe that it is financially sound to sell there and other institutions believe that it is profitable to buy there. At every tick, there are institutions buying and other institutions selling, and all have proven systems that will make money by placing those trades. You should always be trading in the direction of the majority of institutional dollars because they control where the market is heading. At the end of the day, when you look at a printout of day's chart, how can you tell what the institution did during the day? The answer is simple. Whenever the market went up, the bulk of institutional money was buying, and whenever the market went down, more money went into selling. Just look at any segment of chart where the market went up or down and study every bar, and you will soon notice many repeatable patterns. With time, you will begin to see those patterns unfold in real time, and that will give you confidence to place your trades. Some of the price action is subtle, so be open to every possibility. For example, sometimes when the market is working higher, a bar will trade below the low of the prior bar, yet the trend continues higher. You have to assume that the big money was buying and at below the low of that prior bar, and that is also what many experienced traders were doing. They bought exactly where big traders let themselves get stopped out with a loss or where the other big traders sorted, believing that the market was beginning to sell off. Once you get comfortable with the idea that strong trends often have pullbacks and big money is buying them rather than selling them, you will be in position to make some great trades that previously thought were exactly the wrong things to do. Don't think too hard about it. If the market is going up, institutions are buying constantly, even at times when you think that you should stop yourself out of your long with loss. Your job is to follow their behavior and not use too much logic to deny what is happening right in front of you. It does not matter if it seems counterintuitive. All what that matters is that the market is going up and therefore institutions are predominantly buying, and so should you. Institutions are generally considered to be smart money, meaning that they are smart enough to make a living by trading and they trade a large volume every day. Television still use the term institution to refer to traditional institutions like mutual fund, bank, brokerage houses, insurance companies, pension funds, and hedge funds. These companies used to account for most of the volume and they mostly trade on fundamentals. Their trading controls the direction of the market on daily and weekly chart and a lot of the big intraday swings. Until a decade or so ago, most of the trades decisions were made and most trading was done by very smart traders. But it is now increasingly being done by computers. They have programs that can instantly analyze economic data and immediately place trades based on that analysis without a person ever being involved in the trade. In addition, other firms trade huge volumes by using computer programs that place trades based on the statistical analysis of the price action. Computer generated trading now accounts for as much as 70% of the day's volume. Computers are very good at making decisions and playing chess and winning at Jeopardy are more difficulty than trading stocks. Garvey Kasparov for years made the best chess decision in the world, yet a computer made better decision in 1997 and beat him. Ken Jennings was heralded as the greatest Jeopardy player of all time, yet a computer destroyed him in 2011. It is only a matter of time before computers are widely accepted as the best decision makers for institutional trading. Since programs use objective mathematical analysis, there should be a tendency for support and residence areas to become more clearly defined. For example, measured move projections should become more precise as more of the volume is traded based on the precise mathematical logic. Also, there might be a tendency toward more protracted tight channels as programmed by small pullbacks on the daily chart. However, if enough program exit longs or go short at the same key level, sell off might become larger and faster. Will the changes the dramatic? Probably not, since the same general forces were operating when everything was done manually. But nonetheless, there should be some move toward mathematical perfection as more of the emotion is removed from trading. As these other firms contribute more and more to the movement of the market and as traditional institutions increasingly use computer to analyze and place their trades, the term institution is become vague. It is better for an individual trade to think of an institution as any of the different entities that trade enough volume to be a significant contributor to the price action. Since these buy and sell programs generate most of the volume, they are the most important contributor to the appearance of every chart and they create most of the trading opportunities for individual investors. Yet it's nice to know that Cisco system had a strong earning report and is moving up, and if you are an investor who wants to hold a stock for many months, then do what the traditional institutions are doing and buy Cisco. However, if you are a day trader, ignore the news and look at the chart because the program will create patterns that are purely statistical based and have nothing to do with fundamentals, yet offer, offer great trading opportunities. The traditional institution place trade based on fundamental determine the direction and the approximate target of a stock over the next several months, but increasingly firms using statistical analysis to make day trades and other short-term trades determine the path to the to that target and the ultimate high or low of the move. Even on a macro level, fundamentals are only approximate at best. Look at the crashes in 1987 and 2009. Both had violent sell-offs and rallies, yet the fundamental did not change violently in the same short period of time. In both cases, the market got stuck slightly below the monthly trend and the reversal sharply up from it. The market fell because of perceived fundamentals, but the extent of the wall fall was determined by the charts. There are some large patterns that repeat over and over on all time frames and in all markets, like trend, trading ranges, climaxes, and channels. There are also lots of small tradable patterns that are based on just the most recent few bars. These books are a comprehensive guide to help traders understand everything they see on chart, giving them more opportunities to make profitable trades and to avoid losers. The most important message that I can deliver is to focus on the absolute best trades. Avoid the absolute worst setups. Use a profit objective reward that is at least as large as your protective stop risk, and work on increasing the number of shares that you are trading. I freely recognize that every one of my reason behind each step is just my opinion, and my reasoning about why a trade works might be completely wrong. However, there is irrelevant that is irrelevant. What is important is that reading price action is a very effective way to trade, and I have thought a lot about why certain things happen the way they do. I am comfortable with my explanations, and they give me confidence when I place a trade. However, they are irrelevant to my placing trades, so it is not important to me that they are right. Just as I can reverse my opinion about the direction of the market in an instant, I can also reverse my opinion about why a particular pattern works if I come across a reason that is more logical, or if I discovered a flaw in my logic. I am providing the opinions because they are appear to make sense. They might help readers become more comfortable trading certain setups, and they might be intellectually stimulating, but they are not needed for any price action trades. The books are very detailed and difficult to read, and are directed toward serious readers who want to learn as much as they can about reading price charts. However, the concepts are useful to traders at all levels. The book covers many of the standard techniques described by Robert D. Edwards and John Magee. Technical Analysis of Stock Trends, MO.com, 9th edition, 2007, and others, but focus more on individual bars to demonstrate how the information they provide can significantly enhance the risk-reward ratio of trading. Most books point out 3 or 4 trades on a chart, which implies that everything else on the chart is incomprehensive, meaningless, or risky. I believe that there is something to be learned from every tick that takes place during the day, and that there are far more great trades on every chart than just the few obvious ones. But to see them, you have to understand price action, and you cannot dismiss any bars as unimportant. I learned from performing thousands of operations through a microscope that some of most important things can be very small. I read charts bar by bar and look for any information that each bar is telling me. They are all important. At the end of every bar, most traders ask themselves what just took place. With most bars, they conclude that there is nothing worth trading at the moment, so it is just not worth the effort to try to understand. Instead, they choose to wait for some clear and usually larger pattern. It is as if they believe that the bar did not exist, or they dismiss it as just institutional program activity that is not tradable by an individual trader. They do not feel like they are part of the market at these times, but these times constitute the vast majority of the day. Yet, if they look at the volume, all of those bars that they are ignoring have as much volume as the bars they are using for the base of their trades. Clearly, a lot of trading is taking place, but they don't understand how that can be, and essentially pretended that it does not exist, but that is denying reality. There is always trading taking place, and as a trader, you owe it to yourself to understand why it's taking place and to figure out a way to make money of it. Learning what the market is telling you is very time consuming and difficult, but it gives you the foundation that you need to be a successful trader. Unlike most books on candle charts where the majority of readers feel compelled to memorize patterns, these three books of mine provide a rationale for why particular patterns are reliable setups for traders. Some of the terms used have specific meaning to market technicians but different meaning to traders, and I am writing this entirely from traders' perspective. I am certain that many traders already understand everything in this book, but likely would not describe price action in the same way that I do. There are no secrets among successful traders. They all know common setups, and many have their own names for each one. All of them are buying and selling pretty much at the same time, catching the same swings, and they all have their own reasons for getting into a trade. Many trade price action intuitively without ever feeling a need to articulate why a certain setup works. I hope that they enjoy reading my understanding of and perspective on price action, and that this gives them some insight that will improve their already successful trading. The goal for most traders is to maximize trading profits through a style that is compatible with their personalities. Without that compatibility, I believe that it is virtually impossible to trade profitability for the long term. Many traders wonder how long it will take them to be successful and are willing to lose money for some period of time, even a few years. However, it took me over 10 years to be able to trade successfully. Each of us has many considerations and distractions, so the time will vary, but a trader has to work through most obstacles before becoming consistently profitable. I had several major problems that had to be corrected, including raising their three wonderful daughters who always filled my mind with thoughts of them and what I needed to be doing as their father. That was solved as they got older and more independent. Then it took me a long time to accept my personality traits as real and unchangeable, or at least I conclude that I was unwilling to change them. And finally, there was the issue of confidence. I have always been confident to the point of arrogance in so many things that those who know me would be surprised that this was difficult for me. However, deep inside, I believe that I really would never come up with a consistent, profitable approach that I would enjoy employing for many years. Instead, I bought many systems, wrote and tested countless indicators and systems, read many books and magazines, went to seminars, hired tutors, and joined chat rooms. I talked with people who presented themselves as successful traders, but I never saw their account statement and suspect that most could teach but few, if any, could not trade. Usually in trading, those who don't talk and those who talk don't know. Usually in trading, those who know don't talk and those who talk don't know. Great statement. This was all extremely helpful because it showed all of the things that I needed to avoid before becoming successful. Any non-trader who looked at a chart will probably conclude that trading has to be extremely easy. and that is part of appeal. At the end of the day, anyone can look at any chart and see very clear entry and exit points. However, it is much more difficult to do it in real time. There is a natural tendency to want to buy the exact low and never have the trade come back. If it does, a novice will take the loss to avoid a bigger loss, resulting in a series of losing trades that will ultimately bust the trader's account. Using white stop solves that to some extent, but invariably traders will soon hit a few big losses that will put them into the red and make them too scared to continue using that approach. Should you be concerned that making the information in these books available will create lots of great price action traders, all doing the same thing at same time, thereby removing the lead and trends needing to drive the market to your price target? No, because the institution control the market and they already have the smartest traders in the world, and those traders already know everything in these books, at least intuitively. At least intuitively. At every moment, there is an extremely smart institutional bull taking the opposite side of the trade being placed by an extremely smart institutional bear. Since the most important players already know the price action, have having more players know it will not tip the balance one way or the other. I therefore have no concern that what I am writing will stop price action from working. Because of that balance, any is that anyone is always going to be extremely small and any small mistake will result in a loss, no matter how well a person reads a chart. Although it is very difficult to make money as a trader without understanding price action, that knowledge alone is not enough. It takes a long time to learn how to trade after a trader learns to read charts, and trading just as difficult as chart reading. I wrote these books to help people learn to read charts better and to trade better. And if you can do both well, you deserve to be able to take money from the accounts of others and put it into yours. The reason why the patterns that we all see to unfold as they do is because that is appearance that occurs in an efficient market with countless traders placing orders for thousands of different regions. But with the controlling volume bring trade based on sound logic. That is just what it looks like, and it has been that way forever. The same pattern unfolds in all time frames in all markets around the world, and it would simply be possible for all of it to manipulate it instantly on so many different levels. Price action is a manifestation of human behavior and therefore actually has a genetic basis. Until we evolve, it will likely remain largely unchanged, just as it has been unchanged for the 80 years of charts that I have reviewed. Program trading might have changed the appearance slightly, although I can find no evidence to support that theory. If anything, it would make the chart smoother because it is unemotional and it has greatly increased and the volume. Now that most of the volume is being traded automatically by computers and the volume is so huge, irrational and emotional behavior is an significant component of the market and the charts are a purer expression of human tendencies. Since price action comes from our DNA, it will not change until we evolve. When you look at the two charts in figure 1.1, you, your first reaction is that they are just a couple of ordinary charts. But look at the dates at the bottom. These weekly Dow Jones Industrial Average charts from the Depression era and from World War II have the same pattern that we see today in all charts, despite most of today's volume being created by computers. If everybody suddenly become a price action scalper, the smaller pattern might change a little for a while, but over time the efficient market will win out and the boards by all traders will get distilled into a standard price action patterns because that is the inescapable result of countless people behaving logically. Also, the reality is that it is very difficult to trade well, and although basing trades on price action is sound approach, it is still very difficult to do successfully in real time. There just won't be enough traders look doing it well enough, all at the same time, to have any significant influence or over time on the patterns. Just look at Edwards and Maggie. The best traders in the world have been using those ideas for decades and they continue to work again for the same reason. Charts look the way they do because that is the unchangeable fingerprint of an efficient market filled with a huge number of smart people using a huge number of approaches and time frames, all trying to make the most money that they can. For example, Tiger Woods is not hiding anything that he does in golf, and anyone is free to copy him. However, very few people can play golf well enough to make a living at it. The same is true of trading. A trader can know just about everything there is to know and still lose money to because applying all that knowledge in a way that consistently makes money is very difficult to do. Why do so many business schools continues to recommend Edwards and Maggie when their book is essentially simplistic, largely using trend lines, breakouts, and pullbacks as the basis of trading? It is because it works and it always has and it always will. Now that just about all traders have computers with access to intraday data, many of those techniques can be adapted to day trading. Also, candle charts give additional information about who is controlling the market, which result in a more timely entry with smaller risk. Edwards and Maggie's focus is on the overall trend. I use those same basic techniques but pay much closer attention to the individual bars on the chart to improve the risk-reward ratio, and I devote considerable attention to intraday charts. It seemed obvious to me that if one could simply read the charts well enough to be able to enter at the exact times when the move would take off and not come back, then the trader would have a huge advantage. The trader would have a high winning percentage and few losses would be small. I decided that this would be my starting point and what I discovered was that nothing had to be added. In fact, any addition are distractions that result in lower profitability. This sounds so obvious and easy that it is difficult for most people to believe. I am a day trader who relies entirely on price action on the intraday E-mini S&P 500 futures charts, and I believe that reading price action well is an invaluable skill for all traders. Beginners of an instant have a deep-seated belief that something more is required, that maybe some complex mathematical formula that are very few use would give them just the edge that they need. Goldman Sachs is so rich and sophisticated that its traders must have a supercomputer and high-powered software that gives them an advantage that ensures that all the individual traders are doomed to failure. They start looking at all kinds of indicators and playing with the inputs to customize the indicators to make them just right. Every indicator works some of the time, but for me, they obfuscate instead of elucidate. In fact, without even looking at a chart, you can place a buy order and have a 50% chance of being right. I am not dismissing indicator and system out of ignorance of their subtleties. I have spent over 10,000 hours writing and testing indicators and systems over the years and had probably is far more experience than most have. This extensive experience with indicators and systems was an essential part of my becoming a successful trader. Indicators work well for many traders, but the best success comes once a trader finds an approach that is compatible with his or her personality. My single biggest problem with indicators and systems was that I never fully trusted them. At every step I saw exceptions that needed to be tested. I always wanted every last penny out of the market and was never satisfied with the return from a system if I could incorporate a new twist that would make it better. You can optimize constantly, but since the market is always changing from strong trends to tight trading raise and then back again and your optimizations are based on what has recently happened, they will soon fail as the market transitions into a new phase. I am simply too controlling, compulsive, restless, observant and untrusting to make money in the long term of indicator or automated systems, but I am at the extreme in many ways and most people don't have these same issues. Many traders, especially beginners, are drawn to indicators and or any other higher power guru, TV pundit or newsletter that they want to believe will protect them and show their love and approval of them as human beings by giving them lots of money, hoping that an indicator will show them when to enter a trade. What they don't realize is that the vast majority of indicators are based on simple price action, and when I am placing trades, I simply cannot think fast enough to process what several indicators might be telling me. If there is a bull trend, a pullback, and then a rally at a new high, but the rally has lots of overlapping bars, many bear bodies, a couple of small pullback, and prominent tails on the top of the bars, any experienced trader would see that it is a weak test of the trend high and that this should not be happening if the bull trend was still strong. The market is almost certainly transitioning into a trading race and possibly into a bear trend. Traders don't need an oscillator to tell them this. Also, oscillators tend to make traders look for reversal and focus less on price charts. These can be effective tools on most days when the market has two or three reversals lasting an hour or more. The problem comes when the market is trending strongly. If you focus too much on your indicators, you will see that they are forming diverse signals all day long, and you might find yourself repeatedly entering counter-rented and losing money. By the time you come to accept that the market is trending, you will not have enough time left in the day to recoup your losses. Instead, if you were simply looking at a bar or candle chart, you would see that the market is clearly trending, and you would not be tempted by indicators to look for trend reversals. The most common successful reversals first break a trend line with strong momentum and then pull back to test the extreme. And if traders focus too much on divergence, they will often overlook this fundamental fact. Placing a trade because of divergence in the absence of a prior counter-oriented momentum surge that breaks a trend line is a losing strategy. Wait for the trend line break and then see if the test of the old extreme reverses or if the old trend resumes. You do not need an indicator to tell you that a strong reversal here is a high probability to trade, at least for a scalp, and there will most certainly be a divergence. So why complicate your thinking by adding the indicators to your calculus? Some pundits recommend a combination of time frames, indicators, wave counting, and Fibonacci retracement and extensions, but when it comes time to place the trade, they will do it only if there is a good price action setup. Also, when they see a good price action setup, they start looking for indicators that show divergence, different time frames for moving average, test wave counts on Fibonacci setup to confirm what is in front of them. In reality, they are price action traders who are trading exclusively off price action on only one chart but don't feel comfortable admitting it. They are complicating their trading to the point that they certainly are missing many trades because their over analysis takes too much time for them to place their orders, and they are forced to wait for the next setup. The logic just is not there for making the simple so complicated. Obviously, adding any information can lead to better decision making, and many people might be able to process lots of inputs when deciding whether to place a trade, ignoring data. Because of simplistic ideology alone is foolish. The goal is to make money, and traders should do everything they can to maximize their profits. I simply cannot process multiple indicators and time frames well in the time needed to place my orders accurately, and I find that carefully reading a single chart is far more profitable for me. Also, if I rely on indicators, I find that I get lazy in my price action reading and often miss the obvious. Price action is far more important than any other information, and if you sacrifice some of what is telling you to gain information from something else, you are likely making a bad decision. One of the most frustrating things for traders when they are starting out is that everything is so subjective. They want to find a clear set of the rules that guarantee a profit, and they hate how a pattern works on one day but fails on another. Markets are very efficient because you have countless very smart people playing a zero-sum game. For a trader to make money, he has to be consistently better than about half of the other traders out there. Since most of the competitors are profitable institutions, a trader has to be very good. Whenever an edge exists, it is quickly discovered and it disappears. Remember, Someone has to be taking the opposite side of your trade. It won't take them long to figure out your magical system, and once they do, they will stop giving you money. Part of the appeal of trading is that it is a zero-sum game with very small s, and it is intellectually satisfying and financially rewarding to be able to spot and capitalize on these small fleeting opportunities. It can be done, but it is very hard work and it requires relentless discipline. Discipline simply means doing what you do not want to do. We are all intellectually curious, and we have a natural tendency to try new or different things. But the very best trades resist the temptations. You have to stick to your rules and avoid emotions, and you have to patiently wait to take only the best trades. This all appears easy to do when you look at a printed chart at the end of the day, but it's very difficult in real time as you wait bar by bar and sometimes hour by hour. Once a great setup appears, if you are distracted or lulled into complacency, you will miss it and you will then be forced to wait even longer. But if you can develop the patience and the discipline to follow a sound system, the profit potential is huge. There are countless ways to make money trading stocks and M&As, but all require movement. Well, expect for sorting options. If you learn to read the charts, you will catch a great number of these profitable trades every day without ever knowing why some institution started the trend and without ever knowing what an indicator is showing. You don't need these institutions software or analysis because they will show you what they are doing. All you have to do is piggyback onto their trades and you will make a profit. Price action will tell you what they are doing and allow you an early entry with a tight stop. I have found that I consistently make far more money by minimizing what I have to consider when placing a trade. All I need is a single chart on my laptop computer with no indicator, expected 20 bar exponential moving average, which does not require too much analysis and clarifies many good setup each day. Some traders might also look at volumes because an unusually large volume spike sometimes comes near the end of a bear trend, and the next new swing low or two often provide profitable long scalps. Volume spikes also sometimes occur on daily chart when the sell-off is overdone. However, it is not reliable enough to warrant my attention. Many traders consider price action only when trading divergence and throwing pullbacks. In fact, most traders using indicators won't take a trade unless there is a strong signal bar, and many would enter on a strong signal bar if the context was right even if there was no divergence. They like to see a strong close on a large reversal bar, but in reality this is fairly rare in occurrence. The most useful tool for understanding price actions are trend lines and trend channel lines, prior heights and lows, breakout and failed breakouts, the size of bodies and tails on the candles, and relationship between the current bar to the prior several bars. In particular, how the open, high, low, and close of the current bar compare to the action of the prior several bars tells a lot about what will happen next. Charts provide far more information about who is in control of the market than most traders realize. Almost every bar offers most important clues as to where the market is going, and a trader who dismisses any activity as noise is passing up many profitable trades each day. Most of the observations in these books are directly related to placing trades, but a few have to do with simple curious price action tendencies without sufficient dependability to the basis for a trade. I personally rely mainly on candle charts for my mini futures and stock trading, but most signals are also visible on any type of chart and many are even evident on simple line charts. I focus primarily on 5-minute candle charts to illustrate basic principle but also discuss daily and weekly charts as well. Since I am also trade stock forex, treasury notes, future and options, I discuss how price action can be used on the basis of this type of trading. As a trader, I see everything in shades of gray and am consistently thinking in terms of probabilities. If a pattern is setting up and is not perfect but is reasonably similar to a reliable setup, it will likely behave similarly as well. Close is usually close enough. If something resembles a textbook setup, the trade will likely unfold in a way that is similar to trade from the textbook setup. This is the art of trading and it takes years to become good at trading in the gray zone. Everyone wants concrete, clear rules or indicators and chat rooms, newsletters, hotlines, or tutors that will tell them when exactly to get in to minimize risk and maximize profit. But none of it works in the long run. You have to take responsibility for your decisions, but you first have to learn how to make them, and that means that you have to get used to operating in the gray fog. Nothing is ever as clear as black and white, and I have been doing this long enough to appreciate that anything, no matter how unlikely, can and will happen. It's like quantum physics. Every conceivable event has a probability, and so do events that you have yet to consider. It is not emotional, and the reasons why something happens are irrelevant. Watching to see if the Federal Reserve's cut rates today is a waste of time because there is both a bullish and bearish interpretation of anything that the Fed does. What is key is to see what the market does, not what the Fed does. If you think about it, trading is a zero-sum game and it is impossible to have a zero-sum game where rules consistently work. If they worked, everyone would use them and then there would be no one on the other side of the trade. Therefore, the trade could not exist. Guidelines are very helpful but reliable rules cannot exist, and this is usually very troubling to a trader starting out who wants to believe that trading is a game that can be very profitable if only you can come up with just the right set of rules. All rules work some of the time and usually just often enough to fool you into believing that you just need to tweak them a little to get them to work all of the time. You are trying to create a trading god who will protect you, but you are fooling yourself and looking for an easy solution to a game where only hard solutions work. You are competing against the smartest people in the world, and if you are smart enough to come up with a foolproof rule set, so are they, and Then everyone is faced with the zero-sum game dilemma. You cannot make money trading unless you are flexible because you need to go where the market is going, and the market is extremely flexible. It can bend in every direction and for much longer than most would ever imagine. It can also reverse repeatedly over few bars for a long time. Finally, it can and will do everything in between. Never get upset by this and just accept it as reality and admire it as part of the beauty of the game. The market gravitates towards uncertainty. During most of the day, every market has a directional probability of 50-50 of an equidistant move up or down. By that I mean that if you don't even look at a chart and you buy a stock and then place a one cancel order, the other order to exit on a profit taking limit order X cents above your entry on a protective stop at X cents below your entry, you have about 50% chances of being right. Likewise, if you sell any stock at any point in the day without looking at a chart and then place a profit after limit order X cent lower and a protective stop X cents higher, you have about a 50% chances of winning and about a 50% chances of losing. There is the obvious exceptions of X being too large relative the price of the stock. You can't have X be $60 in $50 stock because you would have a 0% chance of losing $60. You also can't have a X be $49 because the odds of losing $49 would also be minuscule. But if you pick a value of X that is within reasonable reach on a time frame, this is generally true. When the market is 50-50, it is uncertain and you cannot rationally have an opinion about its direction. This is the hallmark of a trading range. So whenever you are uncertain, assume that the market is in a trading range. There are brief times on a chart when the directional probability is higher. During a strong trend, it might be 60 or 70%, but that cannot last long because it will gravitate toward uncertainty and 50-50 market where both the bulls and bears feel there is value. When there is a trend and some level of directional certainty, the market will also gravitate towards areas of support and resistance, which are usually some type of measured move away, and those areas are invariably where uncertainty returns and a trading range develops, at least briefly. Never was the news during the trading day. If you want to know about what a news event means, the chart in front of you will tell you. Reports believe that the news is the most important thing in the world and that everything that happens has to be caused by their biggest news story of the day. Since reporters are in the news business, news must be the center of the universe and the cause of everything that happens in the financial markets. When the stock market sold off in mid-March 2011, they attribute it to the earthquake in Japan. It did not matter to them that the market began to sell off 3 weeks earlier after a buy climax. I told the members of my chat room in late February that the odds were good that the markets were going to have a significant correction when I saw a 50 consecutive bull trend spar on the daily chart after a protracted bull run. This was an unusually strong buy climax and an important statement by the market. I had no idea that an earthquake was going to happen in few weeks and did not need to know that anyway. The chart was telling me that traders were doing. They were getting ready to exit their longs and initiate shorts. Television experts are also useless. Invariably, when the market makes a huge move, the reporter will find some confident, convincing expert who dictate it and interview him or her, leading the viewers to believe that this pundit has an uncanny ability to predict the market, despite the untold reality that this same pundit has been wrong in his last 10 predictions. The pundit then makes some future predictions and naive viewers will attach significance to it and let it affecting their trading. What the viewers may not realize is that some pundits are bullish 100% of the time and others are bearish 100% of the time, and still others just swing for the fences all the time and make outrageous predictions. The reporter just rushes to the one who is consistent with day's news, which is totally useless to traders, and in fact it is destructive because it can influence their trading and make them question and deviate from their own methods. No one is ever consistently right more than 60% of the time on these major predictions, and just because pundits are convincing does not make them reliable. There are equally smart and convincing people who believe that the opposite but are not being heard. This is the same as watching a trial and listening to only the defense side of the argument. Hearing only one side is always convincing and always misleading, and rarely better than 50% reliable. Institutional bulls and bears are placing trades all the time, and that is why there is constant uncertainty about the direction of the market. Even in the absence of breaking news, the business channels air interviews all day long and each reporters get to pick one pundit for a report. When you have to realize is that he/she has a 50-50 chance of picking the right one in terms of the market's direction over the next hours or so. If you decide to rely on pundit to make a trading decision and he says that the market will sell off after midday and instead it just keep going up, are you going to look to short? Should you believe this very convincing head trader at one of Wall Street's stock firms? He obviously is making over $1 million a year and they would not pay him that much unless he was able to correctly and consistently predict the market's direction. In fact, he probably can and he is probably a good stock picker, but he almost certainly is not a day trader. It is foolish to believe that just because he can make 50% annually managing money, he can correctly predict the market's direction over the next hour or two. Do the math. If he had that ability, he would be making 1%, 2 or 3 times a day, maybe 100% a year. Since he is not, you know that he does not have the ability. His time frame is months and yours is minutes. Since he is unable to make money by day trading, why would you ever want to make a trade based on someone who is proven failure as a day trader? He has shown you that he cannot make money by day trading by the simple fact that he is not a successful day trader. That immediately tells you that if he day trades, he loses money because if he was unsuccessful at it, that it is what he could choose to do and he would make far more than he is currently making. Even if you are holding trades for months at a time in an attempt to duplicate the results of his funds, it is still foolish to take his advice because he might change his mind next week and you would never know it. Managing a trade once you are in just as important as placing the trade. If you are following the pundit and hope to make 50% a year like he does, you need to follow his management, but you have no ability to do so and you will lose over time employing this strategy. Yes, you will make an occasional great trade, but you can simply do that by randomly buying any stock. The key is whether the approach makes money over 100 trades, not over the first one or two. Follow the advice that you give your kids. Don't fool yourself into believing that what you see on television is real, no matter how polished and convincing it appears to be.